Hello traders, this is Fawad Razakzada, market analyst for City Index. Today is the 20th of February. So the markets are looking quite interesting with the US dollar selling off across the board here. You can see the dollar yen currency pair is breaking below 150 handle. Can it close below that level is the key question. The Japanese yen is higher across the board as Japanese bond yields continue to rise on speculation that the Bank of Japan is going to hike interest rates further at a time when other major central banks are cutting interest rates. So that's putting upward pressure on the Japanese yen and downward pressure on all the yen crosses like the dollar yen, euro yen, etc. The euro dollar is continuing to show bullish characteristics and it's bouncing right where you'd expect it to. Previously, I was expecting a bounce from this shaded area where previously it had formed resistance and where we have the 21-day exponential moving average converging. We broke above this area on Thursday of last week, and the retest of this zone was always going to provide a bounce, which is precisely what we have got here. The key question is, can it break through this trend line resistance? And if it can, then that could potentially pave the way for a break above 105 area, which has been a very important resistance level in the last few weeks. A break above 105 could potentially pave the way for a run to 106, possibly 107 in the days ahead. As things stand, the technical outlook has started to improve on the euro dollar, but if we see a big reversal here and we move below the shaded region, then at that point I will drop my short-term bullish bias on this currency pair. A far more interesting currency pair to watch is the Aussie dollar, I think, because it's finding support from multiple sources. Not only do we have a hawkish leaning RBA governor and data showing improvement in the labour market in Australia, with inflation remaining at the central bank's target, with the risks tilted to either side as per the governor of the RBA. But more to the point is concerns easing about tariffs on China, with Trump signaling that he's ready to make a deal with China. And whenever you hear something positive for the Chinese economy, that tends to support currencies linked to the world's second largest economy. And the most important one of those currencies is the Aussie dollar, because China is the largest trading partner for Australia. So that's the main driving force behind this currency pair. And from a purely technical point of view as well, we've seen some bullish price action in the last few weeks. It all started with the formation of this hammer candle in early this month when rates broke below the prior low but failed to close there. And instead, it rallied and formed this hammer candle. Since then, we've seen a series of higher highs and higher lows on the smaller time frames. We've broken through several resistance levels, including this shaded region last week. And this week, we saw rates come back down to retest this area following a couple of days of consolidation in this continuation pattern. So today what's happened is that we bounced from the support area, prior resistance, and we've taken out the resistance trend of this continuation pattern to the upside. So assuming that the Aussie can hold the rally, a retest of the previous resistance at 63.74, marking the high from Monday, could potentially lead to another push higher, possibly lifting rates to 65 handle next, possibly 65.50 in the days ahead where the 200-day moving average converges with price. Those are my short-term targets, but this rally could last much longer than that, but we'll take it from one level to the next. Now, the US markets wobbled at the start of the trading session there. The major indices fell, and so far it's not looking too bearish. I mean, it's testing this prior support, prior resistance area, I should say, when the index formed resistance here back in December and a couple of more times in January. We broke above this shaded region last week, and now we are retesting this zone from above. So it is still possible we could see a bounce heading into the close. Even if we close around the current levels, this will not necessarily be the end of the bullish trend. I think for me to turn bearish on the S&P 500 in the short-term outlook, it would require a lot more than that. In particular, a breakdown below the 6,000 level is the line in the sand for me, which is what I would be looking for to turn moderately bearish on this market in the short-term outlook. The reason I'm looking at this level is because this level was the prior support range before the index broke out to a new all-time high. So if that level now gives way, I think that would be a bearish signal for the market. In that case, then I'd look for a continuation to the downside towards this long-term bullish trend, or possibly even the 200-day moving average as the next line of support. But for now, we will concentrate on the short-term levels. 6,075 is the level I'm watching. The high of this hammer candle formed on Wednesday, I believe it was, of last week. Yeah, and that level has not been retested once we broke above it. So that's the first line of defense for the bulls, where we also have the 21-day exponential moving average converging as well. Keep an eye on this short-term trend line as well, should we see a deeper pullback. On the upside, there's not much in terms of resistance, so keep an eye on the Fibonacci extension levels derived from the drop from the December high to the January low. The 127.2% extension comes in at 6,190-ish, this area right here. For more market insights and analysis, make sure to check out the news and analysis section at cityindex.com. I'll see you in the next video. Take care.